Imagine discovering that millions of Americans are listed in an obscure federal financial database, not because they broke the law, not for tax evasion, but simply for depositing their own hard-earned money at the bank. This isn't a theory or an exaggeration. It's a fact, happening to ordinary people every day without their knowledge. The law behind this practice is so old that it predates not only the internet, but even the earliest mobile phones. Right now, there exists a rule embedded in your everyday banking experience that quietly flags you for government scrutiny, whether you realize it or not. Most people assume their financial activity is private, but the reality is far more unsettling. Banks are required by law to report certain transactions, regardless of your intentions or innocence. If you're shocked by this, you're not alone. Most Americans have no idea this quiet surveillance mechanism exists. Watch closely, because what you'll learn in the next few minutes may forever change how you handle your finances. Would you have guessed that by simply depositing cash, you could be entered into a secret government file? Stay tuned to uncover how and why this happens and how it could impact you. Let's be crystal clear. This isn't some wild rumor or a fringe internet conspiracy. What we're talking about is codified, enforceable federal law. The reporting system has been written into U.S. statutes, publicly documented, and has been a core part of the American banking landscape since the 1970s. This isn't about partisan politics or speculation. It's a matter of compliance. Banks have no choice but to follow these rules. Most people spend their entire lives banking, running businesses, and depositing paychecks without ever realizing that certain transactions are automatically flagged and sent to government agencies. The mechanisms operate quietly, buried in regulatory paperwork that rarely sees the light of day. But ignorance doesn't protect you. Whether you're a retiree depositing savings or a small business owner cashing out at the end of the week, these federal requirements apply equally. So, as you watch, remember, this is the law, not opinion. Your financial activity is being monitored, not because someone suspects you personally, but because the system is designed to treat everyone the same way, by default. The origins of this reporting rule date back to the year 1970, when President Richard Nixon enacted the Bank Secrecy Act, officially named the Currency and Foreign Transactions Reporting Act. The law's primary goal was simple: to give federal authorities a means to detect large-scale money laundering, drug trafficking, and the financing of criminal enterprises. At the time, illegal operations frequently relied on moving substantial amounts of cash, making it difficult for law enforcement to track illicit funds. The Bank Secrecy Act introduced the concept of a financial tripwire, a specific dollar threshold that, once exceeded, would trigger an automatic report to federal agencies. The belief was that by monitoring large cash movements, authorities could expose criminal networks and disrupt their operations. This made sense in an era when vast criminal fortunes were physically transported in suitcases or duffel bags. The $10,000 limit was chosen as a balance point, high enough to avoid targeting ordinary citizens, but low enough to catch suspicious activity. Over the decades, the law's intent has remained, but its impact on everyday banking has grown far beyond what its authors may have anticipated.
When the $10,000 reporting threshold was set, it represented a significant sum, enough to catch the attention of federal investigators, but not so low as to inconvenience most people. However, there's a critical detail. That $10,000 limit has never been adjusted for inflation. Back in 1970, $10,000 had the purchasing power of roughly $83,000 today. Over 5 decades, as inflation steadily eroded the value of money, the threshold stayed frozen. What was once reserved for massive cash movements is now reached in far more routine circumstances. For example, a contractor receiving payment for a large project or a small business owner depositing the week's cash sales can easily surpass $10,000 in a single transaction. In practical terms, the unchanged threshold means millions more transactions are now flagged than originally intended. The law's net, designed to catch major criminals, has widened exponentially, now capturing everyday financial activity that would have gone unnoticed in the past. This inflexibility in the rules is a major reason why so many ordinary people find themselves swept up in federal reporting, often without any idea it's happening.
This outdated threshold means that everyday Americans are now swept into a system originally built for tracking organized crime. Countless individuals, restaurant owners, auto dealers, freelance workers, and even people just preferring to use cash find their routine transactions flagged automatically. Consider the small business owner who pools weekly earnings, or the contractor paid in cash for a renovation job. These are not criminal acts, but they're subject to the same federal scrutiny as suspicious activity. The reality is, the monitoring net is now so broad that it affects people with no connection to crime whatsoever. Even life events like selling a car, receiving a cash inheritance, or saving up for a big purchase can trigger a report. Many are shocked to learn their names and account information are entered into a federal database simply for using their own money. The law's original aim, to catch major wrongdoers, has morphed into a mass surveillance system where ordinary, law-abiding people are routinely swept up. This impact is largely invisible, but the consequences for privacy and peace of mind are profound.
So, what exactly happens when your cash transaction crosses the $10,000 mark? The procedure is strictly defined by federal regulations. Anytime you deposit, withdraw, or otherwise move $10,000 or more in cash within a single business day or through multiple related transactions, your bank is legally obligated to file a Currency Transaction Report, or CENTR. This is not a discretionary process, it is mandatory. The bank fills out FinCEN Form 104, submits it electronically to the Financial Crimes Enforcement Network, FinCEN, which is a branch of the U.S. Treasury Department specializing in financial intelligence. The reporting must happen within 15 calendar days of the transaction. Every detail, your name, account number, transaction amount, and timing, is included in the report. It doesn't matter if the money is from legitimate sources. Once the threshold is crossed, the report is triggered automatically. This process is uniform across all U.S. banks, ensuring compliance and avoiding hefty fines for the institutions. The result? A detailed snapshot of your transaction enters a vast federal database where it can be accessed by agencies like the IRS, FBI, and others for years to come. Perhaps the most surprising aspect for customers is that banks are not required to notify you when a currency transaction report is filed. There's no letter, no text message, not even a subtle alert in your online banking portal. The entire process occurs behind the scenes, out of sight and out of mind. Your deposit or withdrawal appears as a routine transaction to you, but meanwhile, a detailed report is quietly transmitted to FinCEN. This lack of transparency means you could be entered into a federal system without ever knowing. It's not optional for banks. Failing to file can result in massive penalties, up to $100,000 per violation, so compliance is strictly enforced. For financial institutions, reporting is about self-preservation, not courtesy. The cost of missing a report is simply too high, so banks err on the side of caution. In effect, your right to be informed about your own data is sacrificed for regulatory efficiency, leaving most Americans in the dark about when and why their information is being shared with the government. The magnitude of federal financial reporting is truly staggering. In just 1 year, 2023, American banks and financial institutions filed an estimated 20.8 million currency transaction reports. That's nearly 21 million times someone's financial activity was reported to the federal government, often without their knowledge or suspicion. To put this in perspective, with approximately 258 million adults in the U.S., almost every household is statistically linked to at least one report each year. This isn't just about people suspected of wrongdoing. These reports overwhelmingly capture everyday, legitimate transactions from regular people. The enormous volume has become so great that even law enforcement officials acknowledge it's overwhelming. When banks submit millions of reports on routine activity, genuine criminal actions can get lost in the flood of data. The system built to identify major crimes is now burying investigators under mountains of information, much of it irrelevant. This unprecedented scale means the odds are high that you or someone you know is already in the federal database, even if you've done nothing remotely suspicious. Contrary to what many assume, being flagged in this system isn't reserved for criminals or tax evaders.
Anyone, regardless of background, profession, or intent, can have their financial activity subject to federal reporting. The rules apply equally to the retiree depositing cash savings, the restaurant owner handling daily receipts, or a parent gifting a large sum to their child. Even routine events like selling a used car or receiving a cash inheritance can trigger a report. The process doesn't discriminate based on the source of funds or the individual's history. As a result, countless law-abiding Americans are swept up alongside those the law was designed to target. The database includes names, account numbers, transaction details, and more, available for government review indefinitely. For many, the most unsettling part is knowing that simply handling legal cash in certain amounts can place them under silent federal scrutiny, all without any notification or suspicion. The system treats everyone as a potential subject of interest, regardless of actual risk or behavior. One of the most unsettling truths about these federal financial reports is that they never expire. Once your transaction details are entered into the FinCEN database, they can remain accessible to government agencies indefinitely. There's no automatic removal or expiration date. Your information can be reviewed, cross-referenced, and analyzed years or even decades after the original transaction. This means a completely innocent cash deposit today could resurface in future investigations even if you've done nothing wrong. The permanence of this data poses significant privacy concerns, as it gives law enforcement and regulatory bodies the ability to continually revisit your financial history. The implications are far-reaching. Transactions you barely remember may one day become part of a broader probe or analytics sweep without your knowledge or involvement. The law was designed to build a lasting record, but for ordinary Americans, it creates a permanent shadow over financial privacy, a record that follows you long after the money has changed hands.
Let's dive into one of the least understood financial crimes in the United States, structuring, also called smurfing. Imagine you have $20,000 in legally earned cash and want to deposit it into your bank account. To avoid the automatic government reporting that gets triggered for any cash deposit of $10,000 or more, you decide to split your deposits into three smaller ones, $7,000, $7,000, and $6,000, over a few days. On the surface, this sounds harmless, but according to federal law, this is a felony. Breaking up cash deposits to avoid the $10,000 reporting threshold is considered an intentional attempt to evade federal scrutiny, regardless of where the money came from. The authorities don't have to prove you committed a separate crime, like tax evasion or money laundering. They only need to show you purposely made multiple smaller deposits to sidestep the reporting requirement. In fact, even asking a bank teller, "If I deposit less than $10,000, will you report it?" can be used as evidence of intent. The penalty can include hefty fines and even prison time. This rule applies to all U.S. banks and financial institutions, which monitor for such patterns and are required to report suspected structuring. The reality is, you could find yourself under federal investigation for nothing more than trying to avoid paperwork. Now, let's talk about what happens when authorities act on these financial reports. Under civil asset forfeiture laws, federal agencies like the IRS, FBI, and DEA can seize your money or property based merely on suspicion that it's related to illegal activity, even if you've never been charged with a crime. Here's how it works. If your bank files a report suggesting possible structuring or any suspicious activity, law enforcement may freeze your account and take your cash, often without warning. You don't have to be convicted or even formally accused. The government's threshold of proof in these cases is much lower than in criminal court. Instead, the burden shifts to you. You must prove your money was earned legally and not related to any wrongdoing. This process can take months or even years, often costing more in legal fees than the amount seized. In 2016, for instance, the IRS took $43 million from 600 Americans, most of whom were never charged with any crime. Their only offense was depositing cash in patterns the government found suspicious. For ordinary people, this can mean losing a business, savings, or even a home without ever seeing the inside of a courtroom. It's a controversial practice, and critics argue it punishes innocent people more than actual criminals. Most people have never heard of a Suspicious Activity Report, or SAR, but it's one of the most powerful tools in the government's surveillance arsenal.
Unlike the $10,000 threshold for currency transaction reports, SARs can be triggered at much lower amounts, specifically for any transaction involving $5,000 or more that a bank deems suspicious. But here's the catch. There's no need for proof of a crime, and no specific dollar amount has to be reached. If your bank believes, based on their own judgment, that your funds might be connected to illegal activity, that your transaction lacks a clear lawful purpose, or that you're trying to avoid reporting rules, they're required to file a SAR. This means your bank can file a report on you simply because something about your financial behavior seems unusual to them. The criteria are broad and subjective, allowing a wide range of transactions to be flagged. Once a SAR is filed, it triggers a review that could involve agencies like the IRS, FBI, or DEA, and you have no right to be notified. Over 3 million SARs are filed every year in the United States, covering everything from cash deposits to wire transfers to activity on fintech apps. The SAR system has become a net that catches countless routine transactions, not just criminal ones.
One of the most unsettling aspects of the SAR system is its total secrecy. Federal law strictly prohibits banks from telling you if a SAR has been filed about your account. This isn't just a company rule. Bank employees who reveal the existence of a SAR to anyone outside authorized government channels are committing a federal crime themselves. The goal is to prevent tipping off potential suspects and compromising investigations. But for ordinary customers, this means you could be under government scrutiny and never know it. Your bank is required to file the report in silence, and you'll receive no notification, no explanation, and no opportunity to respond or clarify. Even if the investigation is dropped, or if nothing ever happens as a result, the report remains locked away in a federal database. This absolute secrecy is a cornerstone of the system, making it impossible for you to contest or correct any potentially damaging information. In effect, your financial reputation can be shaped by reports you're not allowed to see, discuss, or dispute. It's a process that leaves consumers powerless, and it's one of the reasons so many people are completely unaware of how deeply their financial lives are monitored.
What actually prompts a bank to file a SAR? It's not just about the amount of money involved. Behavioral patterns play a big role. Banks use a combination of automated systems and human judgment to scan for anything that appears out of the ordinary. Examples include frequent cash deposits just below the reporting threshold, large transfers to foreign accounts, or a sudden spike in account activity that doesn't match your normal income or spending patterns. Even simple actions like round number withdrawals, frequent ATM use, or shifting money between accounts can raise red flags. If you're a small business owner who typically deposits $2,000 a week, but suddenly starts depositing $8,000, that change alone could trigger a SAR. The criteria are intentionally broad, giving banks wide discretion to report anything that seems off. This approach is designed to cast a wide net for potential financial crime, but it also means millions of innocent transactions are swept up in the process. The more your banking behavior deviates from your established history, the greater the risk that your account gets flagged for suspicious activity reporting.
Modern banks rely heavily on advanced surveillance software to monitor customer transactions. These systems analyze enormous streams of financial data in real time, searching for patterns that deviate from the norm. The software uses machine learning algorithms to flag transactions that are unexpected based on your past behavior, income, and typical spending habits. For instance, if you suddenly make a large cash deposit or transfer funds to a foreign country, the system might flag that activity, even if it's perfectly legal. The software doesn't know your personal life story. It only sees numbers, dates, and amounts. When an anomaly is detected, the system automatically alerts compliance officers, who then decide if the activity warrants further investigation or a formal SAR filing. The process is efficient and largely invisible to customers. You won't get a phone call or email warning you about the alert. While these automated tools are intended to stop financial crime, they can also generate false positives, pulling innocent people into the system's web. This high-tech surveillance is now a standard part of banking in America, with millions of accounts being scanned and analyzed every day. Every SAR and currency transaction report filed by banks ends up in a massive, centralized database managed by the Financial Crimes Enforcement Network, FinCEN. This federal agency serves as the nerve center for America's financial intelligence operations. The FinCEN database isn't just massive, it's incredibly powerful. Law enforcement agencies at every level, federal, state, and even local, can request access to its data. The IRS's Criminal Investigation Division, the FBI, the DEA, Homeland Security, state attorneys general, and local prosecutors all rely on this resource to track financial crime. The information stored here doesn't expire. There's no automatic deletion. Once your name is in the system, it can be cross-referenced indefinitely with other investigations. Over time, this allows the government to build detailed financial profiles on millions of individuals, regardless of whether they were ever charged or convicted of a crime. The reach and permanence of FinCEN's central database give it a unique ability to connect dots between seemingly unrelated people and transactions. For the average American, this means that a single flag transaction can become a permanent part of your financial record, accessible to dozens of agencies for years to come. FinCEN's database isn't just a passive repository. Teams of analysts use it to proactively search for patterns and networks of suspicious activity. This means your individual report isn't viewed in isolation. It's analyzed alongside millions of others to identify potential links between people, businesses, and accounts. The government uses sophisticated data mining techniques to map out possible criminal organizations, money laundering schemes, and fraud rings. Analysts look for clusters of transactions that might indicate larger coordinated efforts, like several people depositing similar amounts at the same time, or funds moving through a chain of accounts in different cities. Your innocent transaction could, in theory, become a piece of a much larger puzzle, especially if it shares certain characteristics with other flagged activities. This proactive approach allows law enforcement to spot new threats and open investigations before any crime is officially reported. However, it also increases the risk that ordinary people are swept into broader investigations they have no connection to. The goal is to stay one step ahead of criminals, but the system's reach means everyone's data is constantly being analyzed for patterns that may not even exist. Recognizing the flaws in the current system, Congress took a major step in October 2025 by introducing the Streamline Act. This bill, spearheaded by Senate Banking Committee Chairman Tim Scott and Senator John Kennedy, represents the first serious effort in decades to modernize financial reporting rules. If passed, the law would raise the threshold for automatic currency transaction reports from $10,000 to $30,000 and increase the suspicious activity reporting threshold from $5,000 to $10,000. It would also require these thresholds to be adjusted for inflation every 5 years, preventing them from becoming outdated again. The sponsors argue that these changes would focus enforcement on actual criminal activity instead of overwhelming the system with reports on legitimate transactions. Senator Scott has said the reforms would help protect the privacy of law-abiding citizens, and Senator Kennedy has called the current rules outdated and burdensome. The fact that Congress is openly acknowledging the system's problems is a major development. However, as of 2026, the Streamline Act remains a proposal and is not yet law. Until it passes, the existing thresholds and reporting requirements remain in full effect, and millions of Americans continue to be monitored under the old rules. Despite decades of surveillance and millions of reports filed, the Bank Secrecy Act system is plagued by fundamental problems. The sheer volume of mandatory reports, over 20 million currency transaction reports and more than 3 million suspicious activity reports each year, has created a haystack so vast that it's nearly impossible for investigators to find the real needles. Most reports involve everyday, legal transactions by ordinary Americans, not criminal masterminds. This overwhelming flood of data actually makes it harder to identify genuine cases of money laundering or terrorist financing. Law enforcement agencies are buried under paperwork, forced to sift through millions of false positives to find a handful of true threats. Even members of Congress, like Senator Scott, now admit that the current system does little to prevent actual financial crime. The irony is striking. A system designed to catch criminals is now ensnaring ordinary people, while real criminal activity often slips through the cracks. Until meaningful reforms are enacted, the system will likely continue to generate more noise than useful intelligence, putting innocent people at risk and draining resources that could be better spent elsewhere.
Even as the financial world evolves, the backbone of America's anti-money laundering regime remains firmly in place. The $10,000 reporting rule, introduced by the Bank Secrecy Act in 1970, is still fully operational. Anytime you deposit or withdraw $10,000 or more in cash from your bank, financial institutions are required by law to submit a currency transaction report, CENTR, to federal authorities. This process is not optional, and banks face severe penalties for failing to comply. Smaller, repeated transactions that appear to be structured intentionally to avoid the threshold also trigger Suspicious Activity Reports, SARs. These reports are generated without your knowledge, and you are never notified when your activity is reported. This system, originally built to expose organized crime, now regularly captures everyday financial actions by law-abiding citizens. While lawmakers occasionally debate raising the reporting threshold, as of now, no new legislation has changed these rules. Whether you're a small business owner, a retiree handling savings, or simply moving money, the government's financial monitoring net is as wide as ever. The rules apply to every American. Every account, no exceptions.
Host, walking past digital screens of crypto exchange logos. The days of cryptocurrency operating in a regulatory gray area are officially over. As of January 2026, the IRS enforces strict new rules that require every major cryptocurrency exchange in the United States, like Coinbase, Kraken, and others, to report extensive details about your digital asset transactions. Unlike previous years, where only the sale price was reported, platforms must now disclose the full cost basis, what you originally paid, what you sold for, and the taxable gain or loss for every crypto transaction. This level of transparency means the IRS now has as much insight into your crypto holdings as it does with your stock portfolio. But the changes don't stop at just reporting. Any crypto transaction exceeding $10,000 is now subject to the same federal reporting regime that governs large cash transactions. The infrastructure originally designed for cash is now fully adapted to digital assets. This integration extends government oversight deeper into the world of decentralized finance. If you thought your crypto trades were invisible or anonymous, that era has ended. Digital currency is now under the same financial microscope as physical cash. The introduction of the Genius Act represents a monumental leap in the federal government's ability to monitor and regulate money in real time. Passed to provide a formal legal framework for stablecoins, digital tokens backed by the U.S. dollar, the Genius Act has led to the creation of federally regulated digital dollars. These aren't just theoretical. Digital dollars now move at the speed of the internet, with each transaction instantly logged, tracked, and auditable by federal authorities. Every time you send, receive, or convert stablecoins over regulated platforms, your activity is integrated into the same FinCEN system that's been tracking cash for decades. What once required weeks of manual paperwork and cross-checking can now be done automatically, with AI-driven algorithms scanning millions of transactions per second. The original $10,000 reporting rule, designed for an era of paper ledgers, now applies seamlessly to these high-velocity digital flows. This expansion means that your financial footprint, whether cash, crypto, or digital dollars, is visible to regulators in ways unimaginable even a decade ago. The scale and speed of surveillance have reached a level that fundamentally changes how Americans must think about privacy and money. Host, holding a copy of Executive Order 14247. In January 2026, President Donald Trump signed Executive Order 14247, a directive that quietly but radically transformed how Americans interact with the IRS. This order mandated that all government payments, including tax refunds, federal benefits, and payments to vendors, transition entirely to electronic transfers. Paper checks are being phased out across the board. While the official rationale focused on reducing fraud, cutting administrative costs, and accelerating payment delivery, the larger impact is on data integration. Every payment routed through the new standardized system is instantly cross-referenced with information already held by the IRS and FinCEN. This means it's now much easier for authorities to match government payouts with your reported income and bank activity. If there's a discrepancy between what you claim and what flows in and out of your accounts, the system can flag it automatically. The order has made the government's financial data ecosystem more interconnected than ever. It's not just about faster payments, it's a leap toward a fully digital, highly surveilled tax infrastructure.
So, what actually happens to all these reports banks and exchanges send to the government? The Internal Revenue Service processes millions of currency transaction reports, CTRs, and suspicious activity reports every year, and each one feeds into a sophisticated surveillance and enforcement apparatus. First, the IRS uses this data to select candidates for audits. If the sum of your bank deposits doesn't align with your reported income, that's an automatic red flag. Even if you haven't done anything wrong, a mismatch can prompt a deep dive into your finances. Second, the IRS refers cases to its Criminal Investigation Unit. Investigators use patterns in the reported data to uncover potential tax evasion, money laundering, or structuring offenses. These investigations often begin not with outside tips, but with anomalies spotted directly within the FinCEN database. Third, and most controversially, the IRS can initiate civil asset forfeiture. In these cases, your funds can be seized based on suspicion alone, no criminal charge or conviction required. The burden of proof shifts onto you to reclaim your money. This is not theory. It's a documented reality that has affected thousands of Americans, sometimes with devastating consequences. The consequences of these laws aren't just theoretical. They ripple through the lives of regular Americans every year. Consider the case of a family-run restaurant that deposited its daily cash earnings in increments, trying to avoid theft and keep operations smooth. The IRS seized their entire account, claiming the deposits were structured to avoid reporting requirements, even though all the money was legally earned. Or take the example of a retired couple who sold a classic car and deposited the cash at their local bank. The transaction triggered a center, and when the numbers didn't match their usual income profile, they faced a lengthy audit and temporary freezing of their funds. There are hundreds of documented stories like these. In 2016 alone, the IRS confiscated $43 million from more than 600 individuals in cases where no criminal charges were ever filed. For many, it took years and costly legal battles to recover their money, if they ever did. These stories underline the real risks of innocent people being swept up by a system originally designed to catch criminals. Now that you know how far these regulations reach, what can you do to safeguard your finances? First, understand that any cash transaction over $10,000 will be reported. This is automatic and cannot be avoided. Never try to break up deposits or withdrawals to sidestep this rule. Doing so, even with legitimate money, is a federal felony known as structuring. Second, if you operate a cash-heavy business, keep meticulous records. Store every receipt, invoice, and contract to clearly document the source and purpose of your funds. Your paperwork is your best defense if the IRS comes calling. Third, be aware of what triggers suspicious activity reports. Unusual patterns like rapid, large deposits, frequent round number transactions, or moving money between accounts without clear rationale. Compliance software is designed to spot these behaviors. Fourth, monitor legislative updates. There is a proposal in Congress to raise the reporting threshold, but it has not become law. Until then, the $10,000 rule remains. Finally, if you hold or trade cryptocurrency, recognize that digital assets are now fully visible to the IRS. Stay diligent and proactive. Knowledge is your first line of protection. We've covered a lot, but the essential message is this. Awareness is your strongest ally in today's financial environment. The rules around cash, crypto, and digital dollars are more complex and far-reaching than ever before, and the government's monitoring systems are only becoming more sophisticated. The $10,000 rule, once a tool to catch hardened criminals, now sweeps up the finances of ordinary people. Civil asset forfeiture, automated audits, and real-time surveillance are no longer rare exceptions. They are woven into the fabric of modern banking. But knowledge is empowering. By understanding the laws, keeping thorough records, and staying alert to new developments, you can protect your assets and your freedom. Don't let the complexity of the system intimidate you. Instead, use your understanding as a shield. Stay informed, act transparently, and remember, it's your responsibility to defend your financial privacy. Share this video so others can be empowered too. Your vigilance is your best defense.